Let's take a look at the bigger picture. Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial, is with us. Good afternoon, Ed. How are you feeling about 2024? I mean, we had an incredible run for, people. When I asked Ted Weisberg here on the floor, I said, "What'd you think about 2023?" He said, "Well, the last 2 months saved us," is what he said. Your thoughts about what we're looking at now?
Yeah, well, thanks for having me back and Happy New Year. And I think, 2024, I'm cautiously optimistic. I think as long as rates come down, I mean, bond yields are up a little bit today. And we were kind of seeing that at the beginning at the market open. But, as long as the Feds bring rates down, that's really what the market is priced in. And I think the market is going to do well this year, as long as everything remains status quo. I mean, we've got some things looming like the debt, we've got some proxy wars going on right now. And as long as we don't enter into any direct military conflicts with China or Iran, I think between now and the election, we could have another decent run. But again, I'm very, very cautious with everything going on in the world right now.
And you do like fixed income, right? I mean, that's one of the areas that you think should be in a portfolio. Explain why.
Yeah, as yields drop, the value of cash continues to go down, and so fixed income going out as far as 7, 10 years or even just a little bit longer, it's producing a much higher rate of return, and so it's a better value, a better deal right now than cash and even short-term treasuries. So as part of an overall portfolio, that kind of mixed with certain commodities. And, I really like healthcare. It's been beat up a lot lately. I like healthcare going into this year, and, I like industrials. So, I think that there's some really good plays looking at some good value companies that are paying dividends, strong balance sheets. I think there's a lot of opportunities if it's done right this year and being safe at the same time.
So, all the Magnificent Seven lower today. Do you think there's opportunity in some of those names?
You know what? I do. I think tech is not done with the run. There may be a little bit of volatility, some profit taking early on this year. But, again, AI, I mean, that is, the way of the future. And I think that there's still a lot of opportunity there. I know Apple was downgraded, today. But still, I think that there's room for that this year as well.
Right, understood. And small caps, you're interested in small caps. I mean, they really have had a hard time. Granted, they get these little pops, but for the most part, underperforming group, right?
It has. And again, that's kind of the lifeblood of America. And that's really the telltale sign. So when small caps do well, I mean, that's a sign that the economy is really turning around. And we saw a really good run up at the end of last year, from the end of October, beginning of November through the end of the year, a very, very long Santa rally. And, again, everything has to do with rates and credit, available credit to the small companies. And as long as that's available as rates go down, I think small caps are going to do very, very well.
Right, understood. I mean, on Friday, we'll be getting the jobs report. Looking forward to that. I mean, what are you thinking there? Because the estimations, according to the Bureau of Labor Services, labor statistics, 155 for non-farm payrolls is the number. That'll be down from 199,000 in November. And unemployment rate could tick up to 3.8%. What do you think? What are we going to see in the jobs picture?
I think those estimates are going to be pretty close to, to what we're seeing towards the end of last year. And if those jobs numbers, are reality, the Feds are going to look at that, and, they may start lowering rates a little bit sooner. I've always been saying that we're probably going to start seeing it in May. And I know that there are estimates, people saying as soon as, February, March. I don't see it happening that quick. I do see rates starting to lower in May. And again, it has a lot to do with the jobs reports and the slowing of the economy. So I think the numbers that they're predicting are going to be pretty spot on.
What do you think about the call for the Fed? I mean, people are thinking, first of all, we'll have Fed minutes this week as well. But the Fed laid out 3 cuts, but we're seeing folks pricing in 6 cuts, 7 cuts.
Yeah, you have to remember because the Feds at the dot plot last year or 2 years ago, 2022 going into 23, they were predicting for 2024 there were going to be four cuts. And then in August, in the August meeting, they lowered that estimate to only two, 50 basis points estimated, and so now they're up to three. And so I think because they lowered the estimate and then raised it, that's why the market is adding additional cuts in. I don't think we'll see six cuts, but I would not be surprised if we see four. And as much as one, maybe even 1.25% drop. Again, as the capital markets continue to push bond yields down, that's really signaling the Feds, hey, let's go ahead and lower the rates.
Right, understood. And just a final thought, anything I'm leaving out in the big picture, whether it's housing or the strength of the consumer, any other investing advice that you have to folks that, this could be another great year in that maybe it won't be a 20% year, but it is an election year.
That's right. Yeah, and that's, I think, between now and the election, there's a lot of money to be made as long as everything remains status quo. Now, as far as the consumer and the strength of the consumer, it continues to be a struggle, for Main Street because, prices are still really high. They really haven't started to come down, especially as it relates to housing. When we saw the 30-year mortgage hit 8.3% in October, prices kind of they finally started to drop a little bit. But I think the problem we're going to see for consumers and Americans is as rates go down, we could see those housing prices go back up again. So, it's a double-edged sword. Those folks that wanted to get out of their homes and buy something else, it didn't make sense to give that 2.5%, 3.5% mortgage for 7.5 or 8%. But as rates go down, it may kind of spur on that kind of growth in the housing market.
Yeah, I mean, we had 30-year fixed at 8.45 in October. It went down to 6.6 by December. So we'll have to see. Ed Siddell, EGSI Financial. Thank you so much. Great to see you.
Thank you.